Wait, Fook, let's start with you. Mark says no lending, no rate cut this year. You say still two.
Yeah, I think we will gravitate towards what the Fed is guiding us, two rate cuts. Well, growth has been pretty strong, but we think the full impact of that 500 basis points of rate hikes from a year or two ago, from 0 to 5.25, I think that full impact will be felt later this year. And that would kind of guide the Fed to really relax somewhat.
So what would it take to fully price out the rate cuts and for Mark to be right?
Well, Mark is of the view that there will be rate hikes, right?
I think we'll get to a world where we start considering the idea of rate hikes. So I think that at the moment, there's no sign of disinflation. Even Powell's admitting that, and he's the biggest dove in the world. So there's no sign of disinflation. The economy is really strong. The labour market's really strong. So I just don't. I think we're going to get to a scenario where we at least consider rate hikes. Whether they're delivered or not is different. But I think, it's not even near close to the time where you start fighting this kind of move up higher in yields. And I think that's the issue. So I'm curious, if you think two cuts still this year, when do you think the first cut comes, if you think we're going to get two?
Probably,
and what is going to justify it by then? Is it a sharp economic slowdown, or where is this magical disinflation coming from to allow that first cut?
It would be the second half, obviously, and there should be some signs of slowdown. But really, if you kind of look at US, you can't kind of look at it in isolation. It's part of the whole ecosystem of the world economy. And if Japan and European central bank rates are coming down, it's hard to see the Fed kind of, go all in terms of more rate hikes, having already done 500 over basis points.
But it may not, okay, that's not for more hikes, but why will it cut? I mean, it doesn't have an international mandate. It doesn't have to worry about the rest of the world. It is the most important central bank in terms of monetary policy. It controls basically the financing system, and its economy is still strong. I get your point that ultimately a strong dollar is deflationary, but we're seeing no sign of that yet. And the Fed has repeatedly been wrong for the last few years, and so can it risk making this error the third time again?
So the Fed controls the short end of the market through its Fed funds policy. But it could be a situation where the dollar becomes a lot stronger, because of the reassessment of the trajectory of rate cuts, as well as long-term yields may actually go up. So that could also be a deflationary force. And given that inflation hopefully is not going to kind of rear its ugly head and go above 3%, 2+, I think there is room for the Fed to ease off somewhat. Yeah.
So no agreement when it comes to cuts or not, but there is agreement that yields are trending higher. And Mark, you say that there is room, a lot of room for yields to go up.
Yeah, I think so. I mean, I think the long end will go higher. I think we're going to see 10-year yields easily above 5%. I think the neutral rate is much higher than people have considered the last few years. And I think we're going to a world of generally higher yields at some point. I said, I'm not, whether we get actually hikes next or cuts at some point in the cycle, I don't know. But there's no justification for cuts anytime soon. The only way we're going to get those cuts is because we see some severe slowdown in the economy. And none of the risks we're talking about at the moment are going to provide that. They're not systemic enough. Whether it's regional banks, there's going to be problems, not systemic. Commercial real estate, not systemic. So it needs to be some true black swan that's going to derail that, or it's going to take time. I take your point that a stronger dollar will ultimately be deflationary, but that's a dynamic for next year. We're nowhere close to that scenario right now. So I think yields are going much higher first.
Where are yields headed? 10s, 2s, and also what's neutral? The new neutral.
So yeah, we think the slower they kind of cut rates, the more the long end of the yield curve will go up, and that's also due to a lot of supply of treasuries. So that's going to put upward pressure on long-term yields. So the curve will steepen as they start to kind of cut slowly. The curve will steepen. So from a portfolio construction perspective, we are comfortable. We're actually quite happy that it's higher for longer, because the way we kind of guide our clients, the private wealth clients, is really to deploy your excess cash to work today, because the way we do it is on the income generation part of the portfolio, buy into 3 to 5 year investment grade bonds that is giving you north of 6% yield. So that is an anchor for your portfolio. And really, even if the Fed were to raise rates, as Mark would contend it would, it's okay, because you're on the short data. There's a pool to par anyway, so you're locking in 6% or plus 6%. So that's.
But in terms of stocks, where do you deploy your money? Because higher yields usually would hurt stocks. We have seen that happen, and that is to be expected. How do you deploy your money?
Yeah, we think what we have seen in the stock market last year was really driven by technology. We think there is going to be a broadening of the rally. Now, technology will still be our structural overweight because, of the secular growth trends, AI and what have you. But we think other sectors where the price-to-earnings ratios are really very reasonable. And you exclude technology, actually the stock market is not really in a bubble stage. For example, financials are trading at 10, 12 times price-to-earnings, energy too. So we actually like some of these sectors, in particular energy.
And Mark, you're liking stocks. You say, never mind, if yields are headed higher, stocks the way to go.
Yeah. No landing bull market. I'm completely with you on the broadening rally.
Finally!
It's no fun talking about what we agree on. We're both, absolutely bullish all year, and I agree with you in the broadening the rally. I'll tell you, I want to know about how far it's going to broaden, because one part I've got wrong is I thought it would go to emerging markets at some point. I have been wrong on the going to the Hong Kong stocks. That's clearly not worked. And I do kind of think that, things like Brazilian stocks just looked exceptionally discounted now. They've got the whole commodity story. They've got a good growth story. And yet they're really seeing no benefits to the narrative that's kind of trading around the developed market world. And so I'm just wondering, when do you think that emerging market story works, and which emerging markets do you like?
We've been waiting for a long time for emerging markets to kind of come back. But the headwinds still towards emerging markets would be the strong dollar, higher interest rates in the US. But once that kind of tapers off, I think there should be some outflow from the US market into emerging markets. China is, of course, the biggest weighting within the EM market. And in the case of China, valuations are super cheap. So we think downside is fairly limited. But for China to rise, including Asia, we need to see really very strong policy response, sustained policy response on the fiscal side. We have yet to see that. But once that kind of unfolds, I think at the same time when the US dollar kind of peaks out, I think that would be a good time.
I mean, I think there's a lot of optimism between the two of you. What might break if yields continue to climb higher? Wei Fook.
If yields were to climb a lot higher, it has to be, the result of inflation rearing its ugly head. And if that were to happen, I think, we would need to reassess the kind of bullish outlook that we are adopting today. But to see inflation going back up to 4-5%, I think probably not going to come to pass. When it was 4-5%, there was supply chain disruptions, but today there isn't. So I don't think we will go back there. So that's the main risk, basically inflation.
The main risk is also USD exceptionalism. I mean, you can understand if Asian policymakers break out in hives if the dollar remains elevated. We've seen how the yen got to 154, yet no intervention, and we saw how, the Philippine peso is also at record levels.
Yeah, I think dollar strength is a concern over time. The thing that I think might be quite interesting, it sounds like you're kind of open to the idea that maybe these rate cuts won't come, but that, that's going to be problematic in the longer term. And you're asking what's the problem with higher yields. One of the reasons I have this view and I'm bullish is that I don't think higher yields breaks anything this year. Ultimately, this no landing will mean a very hard landing at some point in the future, but I think that's it's a story for way down the line and not something you trade at the moment. But I think that the tail risk that I'm watching for changing the narrative, and I think might shock you, is this idea that, wait a sec, maybe the Fed won't be the exceptional one. Maybe what we're going to need to change our narrative on is that other central banks won't be cutting as much as we think. That I wonder whether our pessimism around growth in the rest of the world might be reaching a bottom. Like we think and know that European growth's been terrible, but maybe European growth's bottomed. Maybe European and Chinese growth starts picking up as well, and we get a general tailwind, and we suddenly go, no one's going to cut much. And in that world, dollar stops strengthening. In fact, as people in line with your view, broaden out their risk investments, that's actually deleveraging from the world's reserve currency. It's releveraging back into the world. And in that world, we actually, without rate cuts, we actually see the dollar start to weaken. And that's where we extend the bull market even further. So that's the tail risk I'm more worried about.